With inflation trending in the right direction, interest rates could start decreasing in 2024. Mark Triplett from Triplett Westendorf is here to discuss the Fed's latest decision. So why did the Federal Reserve keep rates steady?
Well, Samantha, the Federal Reserve is walking a really fine line between trying to slow the economy down and pushing us into a recession. Last year, prices rose as high as 9% year over year. But as of November, the inflation numbers are showing that the inflation year over year has come down to about 3.1%. So we're headed in the right direction. Unemployment is dropping, but the job market seems to be slowing down. So those are all good signs and indications that the Federal Reserve's interest rate hikes are being effective.
And then how likely does a recession seem at this point?
You know, a recession, there's no secret that interest rates, the hikes last year are putting pressure on the economy, and everybody's affected, from home buyers to those with credit card debt, even banks and corporations. I mean, the average APR this last year is as high as 27%. So that makes borrowing costs much more difficult. That slows the economy down. As far as a recession goes, it's really impossible to predict when a recession might happen. But we keep an eye on the CPI reports and job reports because those are all good indicators of where the economy is headed. Regardless of whether we're going to be in a recession or not, it's important, and this is a great reminder, to have a financial plan that helps you during these uncertain times.
Absolutely. And with that, what can consumers do to protect their money as we wait for inflation and interest rates to go down? Game plan here.
Well, we would recommend taking advantage of the higher interest rates right now, maximizing your savings. If you're not taking advantage of online high yield savings accounts, which are paying, some of them over 4.3%, that's really a missed opportunity. And be prepared for stock market volatility. Try to decrease your exposure to short-term market risk. Money that you need to spend in the near term probably shouldn't be sitting in the market. We always encourage our investors to be long-term investors as opposed to short-term investors to avoid having to sell during a downturn. And last, just create that long-term financial plan. It gives you a set of guardrails to help you through these uncertain times.
What are some of the positive signs that you have seen that's like elevated federal interest rates? What are some good things that happened this year moving forward into 2024?
So those that have money that was sitting on the sidelines, that were sitting in bank accounts, they're able to earn an interest rate for the first time in nearly 2 decades that are really worth having. I mean, the inflation has come down, but we're seeing those interest rates still elevated, and that's helping out those savers, people that actually had cash on hand. The market's kind of bounced back too. You know, we're seeing now the signs of the inflation have impacted slowing the economy down, but the market is responding now positively to the jobs reports and CPI data. And so November was an excellent month for the stock market, and those who had the resolve to stay invested and didn't sell out during those ugly months of September and October.